Well, good afternoon, folks, as we are at the end of another week of trading. We'll flick across the calendar and just have a bit of a review as to what has gone on over the course of this week. Now, Monday, we started off on a bit of a negative footing to begin with. You can see Chinese GDP figures, consensus 7.3, actual 6.3, so a pretty sizable miss in terms of GDP, or in terms of growth figures out of China to start the week. That caused a bit of negativity in markets. Markets didn't really want to push higher in line with the movement that we had seen over the course of last week. We'll jump across to some charts in a minute and we'll have a look at that. The RBA, the meeting minutes, did suggest that they did speak about potential for further ongoing rate hikes if the data proved necessary. We did also then have some unemployment figures out of Australia yesterday morning, Thursday morning. You can see employment change, or should I say the unemployment rate, did not rise as expected. Employment change grew higher than consensus, plus full-time employment added 39,000 jobs. Part-time employment decreased, so some positive labour market figures, which did cause a bit of upside in the price of the Australian dollar. So maybe that's something we need to keep an eye on heading into sessions ahead in terms of the price of the Australian dollar. If the incoming economic data continues to be strong, that will increase the likelihood of an interest rate hike from the RBA. Apart from that, had some inflation figures out of the UK, and that is a step in the right direction in terms of the CPI in the UK. You can see previous 8.7, consensus 8.2, and a 0.3% miss, so a sizable decrease of 0.8% from the month before. Now, markets are sterling sold off heavily off the back of that. People are heavily net long sterling, the highest amount of longs, or the heaviest they have been net long since Brexit kicked off a number of years back. So kind of what that means going forward. I mean, Andrew Bailey will breathe a sigh of relief with that, but inflation is still 4 times the Bank of England's target. I mean, let's be real about it. It's still not a good situation in terms of inflation. Yeah, okay, it's cooling down, but I have to remember that's where people's lack of understanding around economics come in. The headline, the news sources, the likes of BBC will be saying, inflation's cooling down, inflation's coming down. Everybody will be start to be happy with that, and people probably start to spend more money again. But the reality is a lot different, right? If you just take this back, like this 8% inflation rate is still 8% higher than the double digits we had mid last year, right? Because it's a yearly figure, it's 8% higher than the double digits we had last year, which those double digits were higher than the 6% we had, 4 or 5% we had at the same point the year before. So, I mean, it's 8% higher than the 10% that we had here, which is higher than the 5% we had here. So cumulatively, it's still up. Price is still up over 20%, as they were this time 2 years ago. So still massive inflation problems, but I mean, I don't know. I don't really want to seem to communicate that to the public, or the public don't really understand how these inflation figures work. But nonetheless, a step in the right direction. Andrew Bailey will be pleased with that. Inflation continues. It doesn't continue to push lower. It's just rising at not as strong of a pace, which still work that needs to be done in terms of getting inflation under control. So long may that continue. Hopefully those prices will continue, but in order to actually get prices under control, they're going to need to go into negative, into disinflation. But these prices will never come down, so I think get used to the higher prices. Apart from that, that's really what we're looking at. This inflation print out of Japan this morning, lower than consensus, but still higher than the previous month. Now, we did have some comments from the Bank of Japan officials, or from an official from the Bank of Japan this morning, suggesting that they were not looking at altering their monetary policy stance, that they were going to continue with their yield curve control. That shows no signs of slowing down just yet. So the Japanese yen popped higher off the back of that, as you can see, a pretty solid, strong 4-hour candle. But apart from that, we have had that bounce back in the dollar. Now, if you looked at that week ahead video that we posted on Monday, we did call this move. We were looking for a bounce back in the dollar, and that is exactly what we have gotten. Aussie, Kiwi, Euro, and Sterling all lower on the week. We got dollar Swiss, dollar CAD, dollar yen all higher on the week. Dollar CAD has not really reacted to that inflation print that we saw a couple of days ago may be in the way that you would hope. So the Canadian dollar has held firm, probably propped up by the price of oil. Oil pushing higher, which has kept the Canadian dollar supported. So, US dollar bouncing back across the board was to be expected this week. We did get a reason for it to pull back. We can see yields over the course of this week higher in the US. We can see the 2-year higher, we can see the 10-year higher. Now that is sort of interesting developments in kind of Fed funds futures. Now in terms of the Fed next Wednesday, they have another interest rate decision. So a 99.8% chance of a hike. That is all but priced in. 20th of September at their next meeting. You can see the change in that, right? A week ago, or a month ago, 66.3% chance of skip that, I'm looking at the wrong one. I was a bit confused there for a second. We see 1 month, 11.9% chance of an interest rate hike. Up to a week ago, 13.5% chance of a hike. Up until yesterday, now an 18% chance of back-to-back interest rate hikes. So bets for rate hikes kind of ramped up a little bit over the course of this week. Maybe preparing for a slightly more hawkish Fed next week. Let's see what they have to say for themselves next week. But to look at double hikes up until the November meeting, or by the November meeting, you can see a month ago they were pricing a 16% chance, then a 26% chance, then a 32% chance as of yesterday. So bets for rate hikes, or bets for back-to-back rate hikes, are being ramped up as we head into the Fed's meeting next week. And that's sort of a credibility test. They did say that it was a unanimous decision that they were going to hike interest rates twice over the rest of this year. Now, if they do go back and backtrack on that, that's not really great for markets, or not really great in terms of their own credibility, is it? Markets will like it. The S&P will push higher off the back of that. Let's see what they have to say for themselves tomorrow. But we'll update tomorrow, next week. We'll update more on that in videos into next week. In terms of the equity picture, you started a bit negative on Monday, didn't really manage to gain much upside, but then did push higher over the course of Tuesday and Wednesday. Then you come into Wednesday evening, where you did have some earnings out of Tesla and Netflix. Now Tesla had posted, or slightly disappointed in terms of earnings, due to the fact that Elon Musk cut prices over the course of Q2. He has suggested since then he's going to continue to cut prices in Q3, and those prices will remain low. Now, there's a bit of negativity surrounding the earnings release from Tesla, and Netflix did miss analyst estimates. Now, we do have a lot more earnings out over the course of next week. Next week is the busier week, so that will raise its head next week in line with the Fed. But as I said, we will update that a little bit more as we get around to it. The DAX is relatively unchanged. So I forgot to mention the Nasdaq, obviously being at the tech index, with those tech stocks being in focus, has had the biggest downside across the US indices over the course of the back end of this week. But the upside has come from the FTSE. That lower than anticipated inflation print caused sterling to get hammered, caused yields on gilts to get hammered, and that was supportive for the FTSE. Reduces the likelihood of the central bank hiking interest rates to where markets had initially anticipated. That is a positive development for the FTSE. So FTSE the big mover this week in terms of stock indexes. Sterling the big mover this week in terms of currencies. Let's keep an eye on those as we head into next week. But Fed next week, a couple of central banks out next week. Got Fed next week, ECB next week, but we'll update that a little bit further we'll update that more once we get around to that next week. But for now, that's sort of where we're at as we head into the close of this week. That'll be it from us for this week. Enjoy your weekend, have a good weekend, and we'll be back next week for another raft of videos.